On January 27th, 2025, a Tuesday, a Chinese AI startup called DeepSeek dropped a model that could do everything ChatGPT could do. Training costs, $5.6 million. American companies had been spending billions. That same day, Nvidia lost $588 billion in market value in a single trading session, the largest single-day loss for any company in the history of financial markets. Not a bad Tuesday. Markets panicked. CNBC anchors made their concerned faces. Your uncle texted the family group chat something incomprehensible about China. And then, within 3 weeks, Nvidia was back. AI stocks recovered. The S&P hit new highs. And Wall Street collectively decided that $588 billion evaporating in one afternoon was actually fine and normal and nothing to worry about. But here's the thing. That was not a recovery. That was a warning. And if you understand what is actually happening inside the AI trade right now, you will realize that what happened in January 2025 was not the crash. It was the trailer. Let's start with the Magnificent Seven, because this is where the story lives. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Broadcom. 7 companies. And as of right now, these 7 stocks make up over 33% of the entire S&P 500. 1/3 of the most important index in the world is 7 companies. Nvidia alone represents close to 8% of the index, a single semiconductor company. Now here is why that number should make you uncomfortable. The S&P 500 has never been more concentrated in a small group of stocks than it is today. Not in 2008, not in the dot-com bubble. Right now is the peak of concentration in the history of American financial markets. And since 2020, the Magnificent Seven have increased nearly 8-fold in total return. The other 493 companies have not even doubled. So what you actually own when you buy a broad index fund today is not really a diversified slice of the American economy. You are buying a heavily leveraged bet on 7 technology companies and their ability to monetize artificial intelligence, which sounds fine. Until you ask one question that Wall Street has been very carefully avoiding. Is AI actually making money yet? Enough to justify what companies are spending on it, because here are the numbers. Amazon spent $89.9 billion on capital expenditure in the first 3 quarters of 2025 alone. Microsoft is spending at a similar pace. Meta, Alphabet, and Oracle together need to raise $86 billion in 2026 just to keep building. That is not a typo. $86 billion combined in 1 year. To put that in human terms, $86 billion is roughly the GDP of Bulgaria. It is 172 million iPhones. It is enough money to buy every NFL franchise twice and still have change left over for a sandwich. And what are they building with all of it? Data centers, chips, infrastructure, the pipes and wires that AI runs through, not the AI products themselves, the plumbing underneath them. Which would be completely fine if the products on top of the plumbing were generating returns that justified the spend. But here's where it gets awkward. Oracle sold $18 billion in bonds in September 2024 to fund its AI infrastructure. The stock dropped 5.6% the next day. It is down 37% since. That is not the behavior of a market that believes in what it is buying. That is the behavior of a market that is politely terrified and smiling through it. Now here is where every financial commentator pulls out the dot-com comparison, and here's where every financial commentator gets it slightly wrong. In 1999, the top 7 stocks in the S&P 500 traded at roughly 66 times forward earnings. Today, the Magnificent Seven traded about 28 times. Bulls will point to this and say, see, we are fine, not a bubble, and they are not entirely wrong. Because there is a real difference. In 1999, companies like Pets.com had no revenue, no profits, just a sock puppet mascot in a dream. The Magnificent Seven are real businesses with real earnings. Apple makes actual money. Microsoft makes actual money. This is not Pets.com. But here's what the bulls are quietly skipping. Torsten Slok, chief economist at Apollo, one of the largest investment firms in the world, said this: the difference between the IT bubble in the 1990s and the AI bubble today is that the top 10 companies in the S&P 500 today are more overvalued than they were in the 1990s, not less, more. And in October 2025, 54% of global fund managers surveyed said AI stocks were in bubble territory. Not Reddit users, not your uncle in the family group chat. Professional fund managers whose entire career depends on being right about this. Even Sam Altman, the CEO of OpenAI, the man who profits more than almost anyone on Earth from AI enthusiasm, said in 2025 he believes an AI bubble is ongoing. When the guy selling the product tells you it might be overpriced, that is worth at least 30 seconds of serious thought. But here's what makes 2026 genuinely different from 1999. And this is the part that almost nobody is talking about. In the dot-com era, if you did not own tech stocks, you were largely fine. The crash was painful, but isolated. Your neighbor, who put everything in Cisco, got destroyed. Your other neighbor, who owned boring companies, came out the other side relatively intact. That option does not exist in the same way today, and here is why. 63% of all US stock funds are now held by passive index funds. Over $13 trillion of money that does not pick stocks, does not read earnings reports, does not care if Nvidia had a good quarter or a catastrophic one. It just buys the index automatically every month on autopilot. Think of it like a conveyor belt. Every time someone contributes to their 401k, money goes onto the belt. The belt feeds into the index. The index is market cap weighted, meaning the bigger a company gets, the more of it the belt buys automatically, which is exactly how Nvidia ended up representing 8% of the S&P 500 without any individual investor consciously deciding, yes, I want 8% of my retirement in one semiconductor company. You did not choose this. The conveyor belt chose it for you, and here's why that matters if things go wrong. When passive fund holders start redeeming during a crash, passive funds do not deliberate. They do not have a meeting. They just sell proportionally across everything, including Nvidia, all at once. In 1999, a tech crash hurt tech investors. In 2026, a Magnificent 7 correction hits your 401k, your retirement account, your index fund, whether you ever consciously made a single AI investment in your life or not. You are already inside this trade. The question is whether you know it. So before you go, open up your index fund and actually look at what is inside it. Find out how much of it is the Magnificent 7. There's a good chance it is higher than you think. Not a reason to panic. These are real companies, not pets.com, but a reason to know what you own. Because the people who got hurt worst in 2000 were not the ones who understood the risk. They were the ones who had no idea what was inside their portfolio until it was too late. Have you ever actually checked yours? Drop it in the comments. And if this changed how you see your money, subscribe to Buckonomics.